Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Amcor plc quarterly report. Amcor plc offers a diverse range of businesses and services that cater to various industries. At the core of their operations are two primary segments: Global Flexible Packaging Solutions and Global Rigid Packaging Solutions. The Global Flexible Packaging Solutions segment provides flexible packaging products made from polymer resin, aluminum, and fiber-based materials to numerous industries, including food and beverage, medical and pharmaceutical, fresh produce, snack food, personal care, and others. This segment caters to the needs of various sectors by offering customized solutions for their packaging requirements. In contrast, the Global Rigid Packaging Solutions segment focuses on manufacturing rigid packaging containers, closures, dispensing devices, and pharma-related products primarily for the food and beverage industry. By providing a range of products under these two segments, Amcor plc has established itself as a leading player in the packaging solutions market. Amcor plc's stock price has experienced a relatively stable period over the past year, with a decline of only 3.1%. This stability can be attributed to several key events that have taken place during this timeframe. The company's Q2 fiscal year 2026 earnings report was a significant event, as Amcor announced adjusted earnings per share, EPS, of $0.86, surpassing analyst estimates. The net sales also increased significantly to $5.45 billion, driven largely by the Berry Global acquisition. Additionally, Amcor reaffirmed its fiscal year 2026 guidance for adjusted EPS and free cash flow. The integration of Berry Global was a major driver of increased sales, earnings, and synergy benefits throughout the year. This strategic move has likely had a positive impact on the company's financial performance, which may have contributed to the stable stock price. Furthermore, Amcor's focus on innovation and sustainability through various initiatives and product developments has also been notable. The company has announced collaborations with other companies, supported reusable packaging initiatives, and showcased its expanded packaging portfolio at industry events. These efforts demonstrate Amcor's commitment to staying ahead of the curve in terms of packaging technology and sustainability. Despite these positive developments, Amcor plc's stock price decline over the past year remained within a relatively narrow range, indicating that the market has not reacted significantly to these news events. This stability suggests that investors have confidence in the company's long-term prospects, which may be contributing to the lack of significant changes in the stock price. Amcor plc market capitalization of $22 billion is significantly larger than the average industry peer of roughly $4 billion. This shows that Amcor plc holds a significant advantage in their industry. Amcor plc trades at a higher price-to-earnings ratio of 187 times and a lower price-to-book ratio of 1.86 times relative within the industry. But when we look at the broader industry, much for its peers are also priced fairly or higher. This indicates an overall sector-level optimism, suggesting that investors are already valuing the industry with a forward premium for the industry, leaving limited opportunity to uncover undervalued stocks. The leverage on the balance sheet appears elevated, with liabilities of 68% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Average liabilities have increased over the past 5 years, which is normal for a growing company. Asset and equity growth have outpaced liabilities, suggesting balanced and healthy expansion. Shareholder equity has increased on average, but the growth is not consistent year over year. This may indicate one-off events such as asset sales or capital raises, rather than durable business performance. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The company have a dividend yield of 5.56%. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth or decline can be identified through a review of the key factors that influence an organization's financial performance. On one hand, revenue growth is primarily driven by significant events such as mergers and acquisitions, which can bring in substantial new business and revenue streams. In this case, the merger with Berry Global Group, Inc., for $10.4 billion was a major contributor to revenue growth. Additionally, Positive currency impacts can also contribute to revenue growth by increasing the value of sales in foreign markets. This is evident from the increase in net sales due to acquisition and positive currency impacts. The combined effect of these factors resulted in a significant increase in net sales, with a notable 68% rise attributed to the merger and positive currency impacts. On the other hand, revenue decline can be attributed to various factors that negatively impact an organization's sales performance. Lower sales volumes and unfavorable price/mix impacts are key drivers of revenue decline. These factors can be caused by a range of internal and external factors, including changes in market demand, competition, or economic conditions. Net income and profit margins. A shift in performance. The extracted summaries reveal a mixed picture of how net income and profit margins have changed over the past year. On one hand, net income has shown significant growth, with an increase of $14 million, or 9%, in Q2 2025 compared to the same period in 2024. This trend continues into Q1 2025, where net income rose by a substantial 24%, reaching $439 million. However, profit margins have not followed suit. Gross profit margin has remained relatively stable, with slight fluctuations between 19% and 19.3%. Operating income margin, on the other hand, has declined significantly, dropping from 9.1% in Q2 2024 to 6.1% in Q2 2025. This downward trend is also evident in Q1 2025, where operating income margin decreased from 9.3% to 7%. The stability of adjusted EBIT as a percentage of net sales at 12.6% and 12.8%, respectively, suggests that the company's core operations are still generating strong earnings. Nevertheless, the decline in operating income margin indicates that costs may be increasing or efficiency improvements are not being realized. Overall, while net income has shown impressive growth, profit margins have taken a hit, highlighting the need for the company to focus on cost management and operational efficiency to maintain its financial performance. The company's financial performance is a positive indicator of its overall health. One key metric that supports this assessment is its operating cash flow, which has been consistently generating significant amounts in recent years. According to the provided information, the company generated $370 million in operating cash flow for 2025 and $159 million for 2024. This trend suggests that the company's operations are producing sufficient cash to meet its financial obligations and invest in growth initiatives. The positive operating cash flow is a testament to the company's ability to manage its finances effectively, which is essential for long-term success. The company's debt level and interest expenses have undergone significant changes in recent years. The current portion of long-term debt has seen a substantial increase from $141 million to $436 million, indicating a rise in short-term liabilities. Furthermore, the total debt has increased by 6.8% from $14,098 million to $15,138 million, while long-term debt has also risen due to the issuance of additional guaranteed senior euro notes. In terms of interest expenses, there have been notable increases across various periods. Interest paid, net of amounts capitalized, has surged by 109% from $140 million to $293 million. Additionally, interest expenses for the 6 months ended December 31, 2025, have increased significantly, rising from -$167 million to -$337 million. The company's interest expense has also seen a substantial increase, with changes ranging from $88 million to $170 million, representing growth rates of up to 101%. These increases in debt and interest expenses suggest that the company is taking on more financial obligations and paying higher costs for borrowing. Management is expressing caution regarding the company's outlook due to various risks and uncertainties. Despite this, they believe the company will continue to have sufficient liquidity to fund operations and meet its commitments. The adoption of new accounting standards may bring changes in financial disclosures, but is not expected to significantly impact the company's consolidated statements. The company has taken steps to manage its exposure to interest rate risk through hedging instruments. This proactive approach suggests that management is actively working to mitigate potential risks and ensure the company's stability. Overall, while there are concerns about the outlook, management appears confident in the company's ability to navigate challenges and maintain liquidity. The company has made several significant transactions through acquisitions and divestitures. In terms of acquisitions, the company has invested heavily in business acquisitions, with a total of $18 million spent in 2025 and $11 million in 2024. Additionally, there is mention of a merger, although specific details are not provided. The company has also engaged in several divestitures, resulting in significant gains. In 2024, the company received proceeds from divestitures totaling $113 million, with no corresponding expenses for cash divested. Furthermore, the company disposed of Baricap for a gain of $15 million and sold its investment in EPAC for an estimated $79 million. The company's financial activities have been marked by a commitment to shareholder value. One key aspect of this is the payment of dividends, which indicates that the company has distributed a portion of its profits to its shareholders. This practice demonstrates a focus on rewarding investors for their loyalty and support. In addition to paying dividends, the company has also engaged in share buybacks. This strategy involves purchasing back outstanding shares from the market, thereby reducing the total number of shares in circulation. By doing so, the company can increase earnings per share and enhance its overall financial performance. There are concerns about inventory buildup in the company's operations. The data shows an increase in inventory levels for raw materials, supplies, work-in-process goods, and finished goods. Specifically, aluminum and PET resin inventories have risen significantly, with 13,925 tons of aluminum and 4,440,909 pounds of PET resin on hand. Furthermore, inventory discrepancies have resulted in substantial losses for the company. A $12 million reduction in inventory was reported due to discrepancies, while manufacturing inefficiencies and management issues led to an additional $15 million in lost inventory value. These findings suggest that the company's inventory management practices may be flawed, leading to unnecessary buildup and financial losses. That concludes the financial summary for Amcor plc. Feel free to comment below, and I will be happy to answer them when possible.